Seth Klarman, billionaire investor and author of Margin of Safety, said this: "The trick of successful investors is to sell when they want to, not when they have to. Owning overvalued securities is the realm of speculators." Hey everyone, and welcome back to another video for today. So in today's video, let's talk about selling stocks. We usually talk about buying stocks, but I do think that it becomes increasingly important to know when to sell a stock and maybe also when to take profits, right? Every time we talk about, is this a stock to buy? Is this stock to buy right now? Is this undervalued? Is it overvalued? Is it a no-brainer, etc., etc.? Right? I think that's 99% of all finance content out there. But selling names, especially names that are extremely overvalued, that are disconnected with reality, maybe taking profits, is in my opinion equally important. And so let's go over a couple of names. Some of the names I own, some of the names you might own as well. But most of this video is about lessons and how we should adapt accordingly. Sounds good? Great. Hit all the buttons. Thank you very much. All right, let's start off here with a couple of things I've said, you might have said as well, right? It might sound familiar. I'm bullish because it will grow a lot. I believe this is not priced in. You don't understand. It's cheaper today than before. This company is trading at X times PE, so this stock should also be trading at that PE. You've heard it before. You've probably seen it in the comment section as well. I might have used one of these sentences before as well, and I might use them in the future, right? Especially in number one, I'm bullish because it will grow a lot. Fair point. You buy a stock, you're bullish on the name because you believe that name will grow a lot over the next coming years. Completely fine. But how much of that growth is already priced into the stock is also important to note. More on that later. It's cheaper today than before, and this company is trading at X times PE or price to free cash flow, price to sales, doesn't matter. So my stock also needs to trade at that multiple. First of all, it's cheaper today than before. There are various reasons why this can happen. We'll use the PayPal example in this case, right? Revenue keeps on growing, but the multiple kept going down, down, down. PayPal is definitely cheaper today than it was before. But in PayPal's case, before, especially when it was at $300 a share, $200 a share, company was also growing much faster. But in my eyes, yes, it is a better company today than before. But there are various examples like this where, yes, it is cheaper today. Maybe there is a real disconnect, or maybe it is cheaper today for a very good reason. Maybe margins are lower today than before. Maybe it isn't so profitable anymore. Maybe, or probably it is growing much slower today than before. All of these reasons are the answer to, yes, it is cheaper today because of that. Then, just because another company in this sector, let's say, is trading at 30 times PE or 30 times price to free cash flow, you name it, does not automatically mean that your stock should also be trading at that same multiple. Different growth rates, different margins, etc., etc. All of that needs to be taken into consideration. Probably the best question you could ask yourself in situations where you don't know, is it overvalued, is it undervalued right now, is the market too hot, etc. If I didn't own this stock today, would I buy it at that current price? If the answer is no, then you know what to do with the shares that you have in your portfolio. If you bought a stock at $20, it's now at $60. Do you still, if you didn't have your shares, would you still buy it today? If the answer is yes, okay, cool. If the answer is no, then maybe today is the day you should be taking profits. Then, the loss aversion in reverse. A lot of the times we are scared to sell a name because, oh, what if that name goes up by 20%, 30% after I sold it? We're more scared of that than we are scared of if that stock drops 20 or 30%. Sometimes you might say this is greed. I would say most of the time this is greed. Then of course, the famous one, You aren't betraying the company by taking profits. You are being disciplined manager of your own capital, right? The stock does not know that you own it. The stock does not know that you're going to buy more or that you're going to sell it. There shouldn't be any emotional connection. Now, people will say, oh, but then why do you still own PayPal? Well, I still own PayPal because I still think it is extremely undervalued. I will stop owning PayPal when either it becomes overvalued, I don't think that will happen, or the thesis does not work anymore. Very simple. Then you can, of course, play with house money. You can also do that because you want to sleep well at night, or you want to secure your profits. Right? You put in, let's say, $10,000 into a position. That position is now $15,000. You take your initial investment off the table and you leave the rest. Right? It's not your money, although you could say, yeah, it is my money, but the money that you put in is already secured. It's back in your cash position. If the stock continues to go up, great, your position continues to go up. But if the stock suddenly crashes because it was overvalued, then your initial buy-in has been secured already. And of course, you don't go broke by taking profits. At the end of the day, and I've said it time and time again, you don't need to be a math genius or anything like that when investing. Investing a lot of the time is purely having control of your own emotions when things go up and especially when things go down. And so if you can do things to make sure that, yes, you do sleep better at night, you can just sit on your hands and do nothing. If you can make your life simple while investing, do it. If that means close out a position of something that's been going up quite a lot, something that's been overvalued, do it. If you want to take profits, do it as well. Simplify your investing life. And I can almost promise you, because I can't promise, I can almost promise you that you will be extremely successful when investing. And here comes the fun part. Let's have a look at the certain names. Name number one, Roku, right? Roku, as you can clearly see, over the past 3 years, stock has actually doubled. But as you can see during this period right here, clear double top in the stock price. But it's not like the business isn't growing or hasn't grown since. No, you can clearly see that Roku, the business, continued to grow. Revenue continued to go up. But it doesn't matter. It doesn't matter, especially not when everything, all of it, was already priced in. And then some. But in this case, it's not like, oh, the thesis is broken, revenues have started to go down, the business is broken. No, the business continued to grow, but this was not the correct price to pay for it. There are various examples like this, and of course, yes, the pandemic is a very specific case, but it happened before and is going to happen again. Sea Limited, same story here. Extremely overvalued right here, but it is not like the company did not continue to grow very fast over the next couple of years. No, it actually did. From 2020 to 2021, revenue more than doubled, while the stock completely crashed. And then it continued to go up and up and up, and I believe it's still expected to grow 20% or so. And as you can see, at these prices right here, the market was comfortable buying it again. Investors were right to buy it again because the business continued to grow, and it actually did it in a more profitable way. Before, it was growth at all cost, and then yes, of course, everything during that period was extremely overvalued. But then the business was not broken, which is why the stock essentially rallied again. And now we have actually a pullback. We've talked about Sea Limited, I think at the end of 2025. I think there is here again a small disconnect. Sea Limited, a Grab, Mercado Libre, these are companies. I do think that Mercado Libre is the best of the bunch, but I'm biased here. There are opportunities, but it's always at a certain price. Moving on to the real extreme cases. What you see here on your screen are two companies that are worth the same. Apparently, according to the market, both of them have approximately the same market cap today. I own both of these companies. One is PayPal, the other one is Rocket Lab. Now, what you see right here is total revenue over the last 12 months. Of course, the orange bars are PayPal, $32.8 billion in revenue. Rocket Lab, $554 million in revenue. 554 million in revenue. same market cap. Now you're going to say, yeah, but Rocket Lab is growing much faster than PayPal. Yeah, okay, fine. But PayPal generates 60 times more revenue than Rocket Lab, and yet they have the same market cap. There's no free cash flow right now for Rocket Lab. There are billions of dollars in free cash flow generated by PayPal. You see how crazy the market can be sometimes. And again, I'm talking here about companies that I own specifically. I am very bullish on Rocket Lab. My initial position in Rocket Lab, my initial buy, is up 20x. I think it's the first time this has happened. Maybe not, but it's 20x. But as you can see, and this is still a company that's expected to double revenue over the next 2 fiscal years. From fiscal 25 to fiscal 27, revenues are expected to double. I do expect that to actually be more than a double because Neutron success, more government contracts and things like that, I think could accelerate this. But even with that said, you are trading at a $51-52 billion market cap, while you're expected to generate, let's even be extremely generous here, $2 billion in revenue, fiscal 27. Still, that's quite a multiple. Now, when I bought Rocket Lab, sub $5 billion market cap, I said, I'm buying this because I do believe that in the future, this is going to become a $100 billion company. So I still have a long time. But yeah, as I've said, I have no issues taking profits with this one when things become extremely stretched. Moving on to the next extreme case, and that's AST Space Mobile. AST is a $32 billion company right now, generating what? Not much. Not much in revenue. Actually, in Q4 fiscal 26, they are expected to generate $69 million. $69 million for a $32 billion company. Does that make any sense? No, it doesn't. You're going to say, yeah, but over the past couple of days, Golden Dome contract, something. Yeah? What's the amount of the contract? Can you tell me? You cannot, because there is no amount of the contract. And these things, again, will take a long time until it actually hits the financials. So here again, you can be extremely bullish on a company, but how many years of the future are priced in today? Would you still be buying AST at $105, $110 per share today or not? You tell me. Another thing here, by the way, and I wouldn't actually be angry at management for both Rocket Lab and AST to use the situation that they're in right now to raise an insane amount of capital in order maybe to accelerate their business. Right? It's not their fault that the market is pushing their companies up to 50 and 30 something billion dollars in market cap. No, maybe use that opportunity to raise a lot of money. Of course, you might not like it because it dilutes your shares. But yeah, sometimes you have to do what you have to do. In this case here, what we see is the shares outstanding of AST have increased by, well, over the past 5 years almost, 51.4%. That's a 51.4% compound annual growth rate, by the way. But of course, doesn't matter because that's 425% since Q3 2021. Doesn't matter since the stock is up way more than that. Well, it does matter if you're buying today. Moving on to the last example, and that's again another name that I own that I'm up significantly on, and that's of course Micron. Now what I'm showing you here with Micron is what has happened over the past 10 years, last 12 months here, so you see the cycles, right? You see the cycles of a memory player, and then you see also the market cap of the company. Now what we're seeing right now is what I predicted and why I actually bought the stock with an average $90. It's because I do believe that right now with HBM, high bandwidth memory, this AI cycle, I do think that the cycle for Micron and the other memory players is going to go on for longer, and it's going to go, of course, much higher. And it has played out, I would even say, quite perfectly. Now, is this the top? $470 billion in market cap? Is that the top? Probably not, right? Because they are still expected to grow revenue over the next coming years quite rapidly. Now, let's have a look at margins for Micron specifically. Operating margin, 32.5%, again, last 12 months, reaching the peak of the previous cycle. Still quite a long way to go, and till we reach the 2018 cycle top here, 49.7%. Free cash flow margin, same story here. Gross profit margin, 45.3%, although we are approaching 60% pretty soon, which also means we might be approaching the peak here of 2018. Net profit margin, 28.1%. Previous peak was 30.6%, and the one before that, 46.8%. But here already we have gone past that previous peak, two previous peaks. Cash from operating activities. Why is that? Because again, with this AI cycle, with HBM, I did expect them to generate a hell of a lot more revenue and profits. But, how much longer will this thing go on for? Do I still need to own it until the end? Because yes, of course, it would be perfect if I time these stops, right? If I can time these stops perfectly, of course, I own it until the last minute, right? If you can tell me exactly that on a Tuesday, February 28th, something like that, 2027, that's going to be the top at 11:35 a.m. in the morning, then okay, great. I'll put a sell order for that day and that price, but I don't know it. So to me, with Micron specifically, I'm of course in a luxurious position. And so yeah, I have discussions with myself. Should I take more profits or should I maybe also close out the whole position? Right now, of course, I'm leaning towards just taking more profits and let the rest ride because the momentum is still with the business. But there will come a point where I will say, actually, you know what? I made enough with this name, right? I mean, if my average is $90 and it is in the $300 per share, why do I need to lose sleep on, are we nearing the peak of this cycle or not, right? Maybe there are other undervalued names in the market where I'm like, I don't have to time anything here. This name is super cheap today. It's probably not going to be overvalued next quarter. Yeah, maybe I'll have and make that decision in the future while I close out that position. It's not going to happen now. It's probably going to happen in the future, especially if the stock does continue to go. Like I said before, if it's at $400, close to $500 pretty soon, then yes, maybe it might be time to say, you know what? Thank you very much for the gains. I see better returns elsewhere. No problems with that. Which leads me to some very, very interesting quotes here. Two from Sir John Templeton. The first one, through reluctance to sell, more than one investor has avoided the capital gains tax, but lost the capital gains itself. I've seen it time and time again. Oh, why sell now? You will have to pay taxes. Well, if you pay taxes, that means you're making money. And yes, probably more times than we can count, people said the same thing. Oh, I don't want to sell because I have to pay taxes. And then, well, guess what? You don't have to pay any taxes because you have zero gains left. Second one, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I don't know where we're at in this cycle right now because there are various baskets in this or sectors in the stock market that are one, extremely undervalued. There are some others that are extremely overvalued. The market itself right now, despite people say, oh, this Buffett Schiller PE thing is extremely high, blah, blah, blah. Well, the companies are also with extremely high margins and quite good earnings growth. So I don't know exactly where we are right now, but I can tell you with specific names that yes, some specific names are extremely cheap, where you can put this in the pessimism basket, and some others are in euphoria. Which of course leads me to this quote from Jim Rogers. It is remarkable how many people mistake a bull market for brains. Right? If everything goes up, doesn't mean you are the smartest investor out there, right? And we've seen that before. And for those that don't know me and haven't followed the channel for a while, you think that I am arrogant right now, but no, I'm not. I've made mistakes before. I'll make mistakes again. But one thing I have said time and time again is that when things go up, people rarely ask questions. And I know this because I run this channel and I see thousands and thousands of comments. I see that most of the times where comments come in with questions is when things go down. Now, we've seen this before, right? With iron, for example. Iron went from $16 all the way to $76 in a matter of what? A couple of months. Rarely has there been a question on why is this happening. But I can tell you that there were quite a lot of questions that have been asked when the stock peaked here at $77 and went all the way down to $33 here. So a 56% drop. The same could be said about Nebius, another name that I also own. Stock went up here. Okay, there were various reasons why, but then it crashed 46.4%. Again, it crashes quite a lot like this, especially high beta names. The answer most of the times is quite simple. Maybe it should have never been this high to start with. Right? Maybe it should never been here at $140 per share, or Iron at $77 per share, or another name at whatever dollars per share. Just coming back down to reality. Closing out the video with the last two here, one from Howard Marks. Prices are too high is far from synonymous with the next move will be downwards. Things can be overpriced and stay that way for a long time or become far more so. We've seen that before as well. A lot of stocks have gone up and they continued to go up. A lot of stocks were overbought, right? If you look at the RSI on the daily, they were overbought, but they were already overbought for a couple of weeks, maybe sometimes a month or two. Same with oversold. Although with oversold, you don't really stay oversold for that long. You can stay overbought for a long period of time. Various reasons for that. Performance of the business. Maybe there was a huge disconnect. We've seen that with Google, for example. And then, the stock just continues to go up and up and up because there are waves of positive catalysts that are coming towards the stock. But that said, and again, I'm going back to maybe the Micron example. Things can stay overpriced. I don't think Micron is overpriced, but it can go higher and higher based on the momentum. The question is, do I want to be the last one to sell, or do I want to be the first one to sell to someone that might become a bag holder?
You've fallen right into my trap! Activate bag holder!
I hope you like that one. Last one here is one from my all-time favorites, Peter Lynch. If discounting terrific things are already in the stock, I don't want to own it. Stand by your stocks as long as the fundamental story hasn't changed. Now, I want to end with this because I know this might contradict a couple of things that I have said. Fundamentally, it's true that a lot of these names, nothing has changed. Fundamentally, these businesses are becoming better and better. Rocket Lab is becoming better and better. Micron has become better and better. With AST, we hope these things become better and better when they start generating a hell of a lot more revenue. But a story can still be a good story. The thing is, maybe I don't want to pay the price for that specific story, which goes back to the question we asked before. If you didn't own the name today, would you still buy it today? If the answer is no, then, well, it's quite clear what you have to do. That will be it for me in this video. I know, a bit of a different type of video, but hopefully you did learn something. You might not agree with me on all of these things. That's completely fine. That's the thing with investing. I invest for myself, you invest for yourself. We will have different opinions. It's completely fine. We do what is best for ourselves to make sure that our gains will be maximized, but our risk should be minimized as well. So that's all I've got for you right now. See you all in the next one. Bye-bye.